There are better places to put your money. Hello, I am Ross and welcome to the Zurich Money Mindset Podcast. We saw that you liked some of the videos that we put up and we thought we'd provide you a little bit more of a deep dive into the theory of some of this finance and investing world. Today, in the first introductory episode, we're going to be talking about when you should invest and why you should invest. Now, I thought I would start with a very basic story of my grandparents who many years ago, when they were saving, and that's a good thing, by the way, they were saving, they were actually storing their money essentially in a tin in the kitchen, hidden from view. So if any would-be robber would come in, hopefully that wouldn't be the first place they would look, and it would be a relatively safe position for their hard-earned money. Of course, they're not the only people doing this. This is a fairly common behavior, certainly in the past. But what's one of the main problems with that? Well, if your money is sitting in a tin in the kitchen, you are earning no income on that, no investment return on that. The good news you do have is that you have the security of your money, but your money is not doing anything for you. So that is one key thing we're trying to address here today, which is that why should you be investing rather than just having your money sitting somewhere doing nothing while you can make a return on that money? As I said, one of the good things about what they were doing was at least they were actually saving in the first place. The same cannot be said of many people today. Is often natural human behavior to want to have immediate gratification, to spend that 100 euros that you have and you've earned on something rather than putting it away. So there is, on the one hand, if you are saving, you should be doing something with that money, but you should also be fundamentally thinking about saving in the first place. And that's really the big question we're trying to answer here in the simple sense is, why should you be investing? It's good for your overall financial security, your overall financial well-being, and you may have some specific goals in mind in the future about what to do with that money you're saving up. And if you're investing that money, you can basically work towards those goals and build up that money with confidence over time. So I wanted to start here with a simple framework about how you can visualize, think about when it's appropriate for you to invest. And the important thing here to remember is it's going to be different for everybody. Everyone's financial circumstances and life circumstances are different. And it's important to realize that you have to factor in certain things before you can decide whether you are really in a position to, save and particularly to invest that money afterwards. One of the main things about investing is you can't have guaranteed returns. You have to take some risk with that money. Now, historically, there's some good news there, which is the data says that by taking some of those risks and investing, you do generate positive returns, but that cannot be guaranteed. And one of the negative things about that is if you have a short-term goal, for example, it's probably not a very good idea to put it in some really high-risk investments because there is the possibility that you might actually have to withdraw some of that money at the worst possible time when the market is down, for example. So thinking about this with a very high level, stylized way of thinking about this. There's no right answer here, by the way. What this is really a combination of lots of individual recommendations over time. You'll see it in lots of different personal finance communities. But let's start here. Number one, ensure that you are able to pay off your essentials. First and foremost, that is basically get a roof over your head, pay for food, pay for transportation to get you to work. This is all the total essential stuff you need to cover first. And then in the case of your income exceeding those types of levels, you start looking at, okay, part two, do I have any very high interest debts or loans? So for example, maybe there are some credit card statements that you still have, some balances on your credit card that you still have. It's not inconceivable that those numbers could be in excess of 20%. When we talked about compound interest and money working for you, well, that money is very specifically working against you. It's very good to make sure that you can limit those and pay down as much as possible, because there's no point in investing money if you have debts that are accruing interest higher than the reasonable returns that you could make with respect to investing. So that is step 2. Step 3, it's then looking more at once you have some confidence that the highest possible interest rate debts are paid off, can you start building what we call an emergency fund? Now, there's lots and lots of estimates of what this should be, 3 months expenditure, 6 months on a more conservative basis. But the idea is essentially you want to make sure that you have some money available to you to be able to set aside in case there's an emergency. And as I said before, you don't want to have to rely on money that you've put in the markets working for you that you might have to then sell at a poor time. So I would recommend generally it makes sense to think about putting some type of savings towards this emergency style kind of fund. Now we're moving on, we're getting closer into investing here. Point 4 is make sure then you understand what other kind of debts it is that you have. And so what do I mean by that? These are not the super high interest credit card bills. These could be things like a mortgage, for example. You could have a mortgage. It's not uncommon for mortgages to be, 30 years in length, but they tend to have interest rates that are significantly lower than credit card bills, for example. So you could think of a mortgage at maybe 3%, maybe 4%, something like that, depending on where you live, depending on the interest rates in your specific economy. But the point there is, it may not be the best idea to just think about paying down all your debts, which means basically paying off your mortgage as quickly as possible, because it actually might be the case that over time it's better to put some of that money into investments rather than these very low yielding or low interest debts that you have as well. So it's just making sure you understand what it is that you're paying there and whether it makes sense for you to either overpay or whether you think that based on some reasonable historic assumptions, you could be expected to maybe make a little bit more than the debts you're paying on your mortgage, for example. We're finally here. The last step now, you've looked at all this checklist and you're actually confident you have some excess money at the end of all of this that you can then set aside into the markets. Now, we want to talk about after this is what specifically can you actually do with that? What does it really mean to invest? So what can you actually invest in? Now, of course, the answer here is there are really limitless options in this world today. But today specifically, I want to focus on what I'd say are 2 classic options that we think about when we look at the types of assets. That's the term we use to describe, the things that we're investing in. The first one is stocks. The second one is bonds. Now, these are, as I said, the 2 kind of classic things you think about investing. Still very, very common today. Lots of historical data on the types of returns that you can expect to get from those. And essentially, what is a stock? So a stock is, in the simplest terms, an ownership stake that you have just bought effectively as an investor in a stock in a company. And that basically means you're a part owner. It means you have some rights and some expectations that when the profits of that company come in, some of that is basically owned by you. And then the basic theory goes that a company is essentially incentivized to grow its profits over time, and hopefully, as part of that, the profits of that company will grow and the value of the shares that you hold will grow. Also, as part of that, there is what we call dividends. Now, some stocks pay more dividends, some stocks pay less dividends, but that is essentially a payment that is made to you, the owner, in the form of cash, effectively, that the company makes from its normal operations. Out of its profits, it will pay those back to you. So that's the classic, very simple idea of stocks. Bonds are, in the simplest term, effectively you loaning money to somebody. So we talked in the kind of first idea, this flowchart concept of, you having debts yourself, be it on a credit card, personal loans, obviously not very uncommon at all. But what people don't often realize is that if you have excess money, you can effectively lend it to other things. You can lend it to governments in the form of government bonds. You can lend it to companies in the form of corporate bonds. And those companies are effectively borrowing that money from the international financial markets, and they're using that money to used for their general operations, for investing in new machinery and plants, and for general ongoing business activities. But they pay for the privilege to do that. They pay an interest. Like, we pay an interest on a personal loan, they pay an interest. And if you buy bonds, effectively, you are buying that stream of interest income over time. So those are the 2 basic ideas. Stocks, ownership in companies on one hand, bonds, effectively you loaning money on the other hand. Now, again, going back to, shall we say, the traditional ideas of these concepts, Stocks are often considered to be the riskier form of investment. You essentially would expect to see generally more what we call volatility in the price, which is the price of the asset that you own can go up an awful lot, but it can also go down an awful lot. Now, if you look at some history of very, very well-known stock markets, they have tended to go up over time as the economy grows. But of course, there are periods when they go down. And that's one thing we talk about when you're thinking about, for example, your emergency fund. You don't want to have your money all invested in the stock market necessarily, because it may be that you have to sell at a point when the markets are down because the economic general situation is weak, or there are other reasons driving maybe a specific industry or company to be a little bit weaker at that point in time. So more volatile stocks on one hand. On the other hand, you have bonds that are generally considered to be a safer asset. There is an expectation of a flow of payments over time. Some bonds pay every year, some bonds pay every half a year or maybe even quarterly, and there's an expectation that the fluctuation of the price of that bond that you hold is not going to be as much as stocks. Generally, and at a very high level, that is true, but it's important to understand that there are nuances and some exceptions within here. For example, if we look at stocks, you could own stocks in extremely high growth, new technology companies that may be exploring something that's a real frontier of science, but we don't really know whether it works conceptually or practically. You can expect the price of that stock to fluctuate an awful lot. On the other hand, you could invest in the stock of an extremely stable company in a very stable industry, and you wouldn't really expect the price of that stock to move as much. Maybe the investment community generally understands that business more. They can predict with greater certainty how much money they expect to make over time, and the volatility, as we say, of that will be lower. So even within stocks, there is difference within that. In bonds, it's the same. At the very, very lowest rank of risk and correspondingly lowest expected return, you would see something like Swiss government bonds. Extremely highly rated, very low debt profile as a country, very low inflation, and very low interest rates. But that means that if you're buying Swiss government bonds, you really wouldn't expect the price of that bond necessarily to move all that much. However, I said you can lend to companies as well. You could be lending to the companies that I mentioned up here in stocks who are in the new, really exciting frontier areas. The problem with that is, because the business is so uncertain, you might actually have a bit of a higher risk investing in that there. The price of the bond may move an awful lot more. The expected interest rate that they pay you will be a lot higher because the market is demanding that to compensate for that kind of risk. But there is also the possibility that they don't pay back at all. So there is default risk there at all. And why am I saying all this? It's to try and get the idea across that essentially there is generally the idea that stocks are riskier than bonds. It is true generally, but there are exceptions within that, and it is very important to recognize some of the nuances within that as well. The last point I want to make here, when we think of the simple idea, stocks are riskier than bonds, there is a very important concept within finance, which is the more risk that is taken, the greater the return that is basically required by investors to justify taking that risk. That is the fundamental reason why over time, even though stocks have been more volatile, the annual returns, if you look at very broad historical series, like for example in the US stock market, you do see that they provide greater annual returns than the bond market does generally. But of course this isn't necessarily true for every year, and we cannot know about the future or what that will hold. All we have there is the historical data, but what we do know is that there is this relationship between the riskiness of an asset and the type of return that you as an investor expect and need to be able to hold that asset, justify holding that asset. So there's a fundamental concept within here, which is the more risk you take, the higher the reward you can be expected. However, the chance of loss goes up. And many people are uncomfortable with that. And that's when it comes into the idea of knowing what you as an individual can accept on a kind of risk basis, how long your investment horizon is. Basically, the longer your horizon is, the more risk and movements of price that you can justify taking. Now, when we think about you as an investor, you can go online and you can often find lots of estimates by various financial institutions about what type of returns are reasonable to expect. And a way of thinking about this that is often done, and I think makes a lot of sense, is you can bucket yourself or your investment style into 3 broad categories. The first one is cautious. The second one is balanced or moderate. And the third one is aggressive. Now, correspondingly, you would expect a cautious portfolio may be making less money than the aggressive portfolio over a very long period of time. That might not necessarily be true, but based on historical data, it could be the case if particularly you have some equity, more equities in there, than a portfolio that is on the very cautious side of the spectrum. The balanced portfolio, of course, somewhere in the middle. Now, what actually constitutes these portfolios? What do they have in them? The more cautious you are, at a very high level, the more you'd expect your portfolio to hold bonds rather than stocks, or sometimes what we call equities. These terms are used interchangeably, but you would hold more bonds than stocks. And particularly, even within the bonds that you would hold higher rated bonds, i.e. the bonds where financial professional agencies say the risk of them defaulting on you is extremely low. The corresponding return is also a little bit lower as well. Now, as you move along to the balanced portfolio, you'd hold fewer bonds. The bond portfolio might hold a little bit more in terms of company or corporate bonds rather than just governments, and you would hold more equities. And then as you slide that along to the aggressive side, you'd hold even fewer bonds, but you'd hold more and more equities. Now, based on historical data, we would say that the expected return of this aggressive portfolio is higher than these ones, but the volatility of the price along the way will also be an awful lot higher as well. That is all we have time for today, and thank you very much for listening to our inaugural episode of Zurich's Money Mindset Podcast. Now, as cringeworthy as this feels to me, my marketing team are telling me I have to say this, so please do not forget to like, comment, and subscribe. Hit that notification bell or something along those lines. It would be greatly appreciated. And please tune into our next episode where we will be diving even deeper into some of these financial concepts. Thank you very much.